We'll call the meeting to order.
Still is us.
When we open the hospital board meeting will come to order also.
We're moving on. Approval of minutes from February 19th, 2020.
I'll motion to approve February 19th regular meeting minutes as presented.
I'll second.
Motion's been made and seconded to approve the February 19th minutes. Any discussion? Hearing none, all in favor?
Aye.
Opposed, motion carries. Changes to agenda. Hearing none, we'll move on to presentations. Northland Securities.
Mayor, Council, members of the board, good evening. I'm Jessica Green with Northland Securities. I'm going to start by asking, does everyone have a copy of the finance plan? If not, I do have extra copies with me, so. Oh, great.
I think we all do.
Okay, anybody else? So as most of you are aware, there is an opportunity to refund the city and the hospital's 2004 loan with the USDA. This is something that we talked about back in 2017 when the hospital was considering doing some renovations to the facility as well, and the market sort of went away and that project got put on hold. So with the recent movement that we've seen in the market, we're looking at that refunding again, and there are some nice savings out there. So I'm going to run through the finance plan that you've got before you, and then walk through the cash flow that we're anticipating. Happy to answer any questions as we go. I'll take questions at the end too, but if there's anything you want to dig into, just let me know. So the first part is the executive summary, and this really just provides sort of high-level detail about the refunding itself. The purpose, as I stated, was to refund the USDA loan from 2004. Proceeds of the refunding bonds would be used to essentially retire that debt with the USDA. Security is the general obligation of the city, but the net revenues of the city's hospital, nursing home, and related facilities are pledged to the payment of those bonds. Bonds would mature annually December 15th in the years 2020 through 2041, so not proposing to change the existing maturity of the loan for the USDA. The payment structure is going to feel a little bit different just because currently the hospital is paying that USDA loan on a monthly basis. This would actually switch it over to principal being paid once a year with interest due twice a year, which is typically how you see general obligation taxes and bonds operate. So again, the bonds maturing annually December 15th, 2020 through 2041, and then interest paid semi-annually December 15th and June 15th of each year. Estimated savings when this plan was drafted, and I'll talk a little bit about that comment in just a moment, but the gross savings here is estimated to be $224,943. Present value of that, so if someone were to give you a check for that money right now today, in today's dollars, you're looking at present value savings of around $353,440. The net present value percentage savings is just over 15%. And to give you some context of that, typically if you're looking at a refunding, really that threshold that you want to start considering a refunding is around 3%. So being at 15%, this is a really nice savings if it can be achieved. So again, just to give you some context there. Average coupon, what we're anticipating, again, at the time the plan was drafted, 2.29%. True interest cost, that includes all of the cost of issuance, is around 2.47. There is a prepayment option in here, so you are able to call the bonds beginning December 15th of 2028. So until that time, there is essentially this lockout period where you're not able to call in the bonds. You're paying that regular principal and interest payment, but you're not able to pay off anything additional. After that 2028 date, you are able to call the bonds in full or in part. But again, there's that call date out there in the future. From the rating perspective, the analysis that we prepared assumes that the city will seek out a rating from Standard & Poor's. Currently, the city's general obligation debt is rated A+ by Standard & Poor's. The city has not been rated in quite some time, and we'll spend some time talking about the rating in just a moment as well. Tax status, we are assuming the bonds will be issued as tax-exempt bonds and also bank-qualified obligations, and that just means that they are a bit more attractive to some bank investors because they are bank-qualified. There are a number of risk factors associated with issuing any debt. There's a number of risk factors at the very, very end of this summary. I won't spend a ton of time on them, but they are in the report for your review. In terms of the method of sale, we are proposing a negotiated sale, so Northland is proposing to purchase the bonds directly from the city. We are anticipating a pricing date of Wednesday, April 8th, and then we would bring that ratified resolution back to the city council at your regularly scheduled meeting in April on the 15th. So going on to that next page, again, it just goes through a number of the areas that are discussed in the executive summary. Again, the purpose here, paying off those USDA bonds, but you'll see the sources and uses here. So we've got the par amount of bonds being issued of $1,950,000, excuse me. The transfer that you're seeing from the prior issue debt service funds there of $11,271. So what that means is from the time of when we begin the, when we sell the bonds to when we're paying those off, there's essentially accumulation of what you're paying on that monthly basis, so that would be collected and used towards the calling in of the existing debt. And then in terms of use of funds, you've got your underwriter's discount there, cost of issuance, that includes all of the estimated costs that we anticipate for the bond issue. So that's the rating, that's legal, that's your fairness opinion. So everything that you would consider as far as cost of issuance, we have estimated in there. So that savings amount that you saw in that executive summary, that is all net of those costs. So those are all included in there. And then you've got a small rounding amount in there, $1,653. That's just because bonds have to be issued in $5,000 denominations, so you've got a little bit of a roundup. Those dollars come back to the city and they're used for that first payment. Bonds will be issued pursuant to Minnesota's state statute, chapter 475, which is the general debt issuing authority, and then section 376, which governs the hospital authority there. Structure, again, looking at very, very similar structure to what you have, other than in terms of how that payment is made on an annual basis. But we're structuring this so that you are seeing relatively level annual debt service savings over the remaining life of the bonds. In terms of security, they are considered general obligations of the city. However, the debt revenues of the hospital, nursing home, and related facilities are pledged to the payment of the bonds. What statute requires is that you are having at least 105% of the debt service that is scheduled to occur collected for that debt service payment. If there is a deficiency below that 105%, then the city would be making available any resources that you have to make that up, that 105%. But again, you're looking at those net revenues from the hospital to pay for that debt service. In terms of plan rationale, again, this is really just for interest savings, so not to shorten or lengthen the term or change the structure in any way, but just interest savings overall. In terms of issuing process, Northland is proposing to act as underwriter in this transaction. We are required to act in an arm's length transaction with the issuer, the city. Also, there would be someone engaged to provide a fairness opinion to you as well, so they would look at the scales, coupons, the interest rates that are being proposed, and provide you with an opinion that the rates being proposed by Northland are such as those that you would see in the market in any other transaction. What you have in, or for consideration later on your agenda, is something that we call a trigger or parameters resolution. There's just a very short paragraph here about that, but what it does is really allow the council to identify a threshold for savings, to say, if we can achieve this dollar amount in savings, we're willing to move forward with this refunding. We've left that amount here blank, and it's also blank in that trigger resolution, so that you can all have a discussion about where you think that savings threshold should be. Some of that will be dependent on kind of where that rating comes back. But the trigger allows both the mayor and the city administrator to execute the bond contract on the date of pricing. So in that executive summary, you saw that we're looking at a pricing date of April 8th, with that award actually occurring on the 15th. The reason that triggers or parameters resolutions are nice is because it gives you some flexibility in the timing of the bond sale. Typically in Minnesota, you see a lot of sales occurring Mondays, Tuesdays, and Wednesdays because they coincide with council meeting dates. So those calendars can get a bit busy, and it tends to happen sort of whether councils are meeting on the first and third weeks or the second and fourth weeks. So again, those calendars sort of start to stack up. This allows you to move into a different cycle. allows for those that are identified to sign the contract to do so, lock in that pricing, and then that resolution is brought forward for ratification at the next full council meeting. So again, it just gives you some flexibility from a timing perspective. Bond counsel for this issue will be tapped out of Minneapolis. Briggs & Morgan has previously acted as the city's bond counsel. They have merged with Taft as of the beginning of the year, so they are one and the same. And then paying agent, we've assumed that you use Northland Trust. You certainly don't have to, but being that you've used them in the past, that's who we have listed in the report here. And then the next two schedules are probably where you're most interested. That schedule on page 4 really just provides you with what the preliminary debt service schedule is based on what we were estimating in terms of rates. The more interesting piece is the schedule on page 5, and that provides you with sort of the savings comparison there. So you've got your old debt service versus the new proposed debt service. And what you can see here is that the new debt service is around $115,000 per year versus the current, which is around $135,000 with the savings averaging out around $20,000 per year. So there, again, you can see that total savings of $424,943. After that transfer in from the existing debt service fund, we are estimating that present value benefit of $353,440. And then on the end there, you're just seeing the bank qualification language in there, so just saying that these are going to be issued as a bank qualified bond. The city is issuing less than $10 million in debt this year, so these can be considered tax exempt bank qualified bonds. Arbitrage is something to be mindful of. That's just to say that you can't invest the proceeds in investments that yield something higher than the rate on the bonds. With the refunding, that's really not an issue because you're using those bond proceeds to essentially pay off debt. So, but certainly we put them in the report so that the city is aware of them. Continuing disclosure, the city will enter into an arrangement to say that you will report certain material events. It's very typical with general obligation debt. Premiums, likely you've all heard of this in the market at this point. Premium is when an investor would like to see a higher coupon or higher interest rate on a bond. So what they're willing to do is provide you with cash upfront to secure that higher interest rate. So in the event that that happens on the sale date, what we would do is take that premium, reduce the bond size. So for even numbers purposes, let's say you've got a bond issue of $2 million and the interest rate is typically around 2%. But an investor would like to give you money up front, so maybe that's $300,000 or so. So you'd be issuing 1.7 at a higher interest rate rather than the full $2 million at the 2%. So overall, from the city's perspective, the overall debt service is the same. It's just that it fits what the investor is looking for and really invites more investors to bid on your bonds. And then we've got just the information there on the rating. Again, we'd be seeking a rating from Standard & Poor's if the council and the board are supportive of doing that. The last time the city was rated, you were rated A+ by Standard & Poor's. In looking at the financial statements, both for the city and for the hospital, there's been a number of interfund loans that have been occurring, and based on our experience, the analysts at Standard & Poor's tend to dig into those quite a bit. So in terms of just overall like managing expectations, you want to be prepared for questions about that and why those are occurring. Obviously the city and the hospital have been doing a great job of paying on all of the debts that are outstanding. So that is not an issue. This is actually going to be seen, I think, as a credit positive because you're putting the city and the hospital in a better position, being that there's some savings there. But again, just want to manage expectations in that we know that they ask questions about interfund loans and that will likely occur here too.
Is the cost of getting that rating put in here too?
It is, yep. So if you were to not seek out a rating, the cost of issuance would be less. But when we look at the difference between, so we would assume that the rating is probably going to cost around $13,000 or so, and that's in there. So that's the net savings is reflective of that. But when we take a look at the A+ rated version to the non-rated version, you're probably losing around $25,000 in net savings. So that means the 13 plus the 25. So you're really losing close to $40,000 total. So if the city is comfortable moving forward with the issuing process, it certainly appears that you would still maintain the A range. I would not be surprised because of the interfund lending if there's a notch downgrade. We'd certainly try to package that up and make it look as good as we can and explain that in you know, very thoughtful ways so that the rating analysts can understand it. But I would not be surprised for them to really take a close eye to those things. But that being said, the non-rated version with the length of this debt being that it goes out to 2041, that can start to get kind of expensive from an investor standpoint. So a rating is, I believe, beneficial in this case, but we really only want to undertake that process if the city's comfortable doing it. So then, just going on with the rest of the report, what you've got is a calendar on the very next page. This just kind of shows you where we are today, just looking at presentation of this plan, and then assuming that you move forward with the trigger resolution. Again, that's only if the city is comfortable doing that. We have already prepared the preliminary official statement, so thank you to Willie for getting us all that information so that we could prepare that. That's ready to go. So if the council decides to move forward tonight, we would ship that off to the rating agency tomorrow and get that rating call scheduled for the week of March 23rd, excuse me. We would hope to have that rating back by April 1st so that we can price on the 8th. And then again, we would have both Willie and the mayor sign that bond purchase agreement, and then we'd come back for ratification before the council on the meeting on the 15th of April. And then you've got those risk factors that I mentioned at the very beginning. So just knowing that the city will need to comply with covenants in the bond resolution, undertaking continuing disclosure requirements, and then being aware of certain IRS regulations that you need to be in compliance with. So with that, I know that's a lot of information all at once, but I am certainly happy to take any questions about the refunding, the rating process, anything.
If we were graded at like an A, what would the change be approximately in the net savings?
It's hard to say. I think that typically between an A plus and an A, you're looking at 5, maybe 10 basis points. The market's just been so volatile that I'm hesitant to put a dollar figure to it. But if we're looking at 40 grand or so between an A plus and a non-rated, maybe 10 to 15. I do think that it is worth it to go through the rating process, as long as the city is comfortable with that and knowing that you're gonna have some questions about kind of tracking of the money and the interfund loans, and if there's a plan for repayment, which I know that there is. But the analysts will wanna hear from the city on how those interfund loans are being managed, and I think that we can do a good job of explaining that. But again, it's up to the city. So.
What does the tax exempt status change if it was taxed?
If it's taxable, it's pretty significant. So when we looked at a taxable deal of this size, the difference in savings is around $150,000. I have talked with, you must be Jake.
Yep.
Hi, I'm Jackson. So I did talk with Dan Burns this morning at length, and so his opinion, he is quite certain that these are tax exempt, regardless of the outreach contracts. His thought is that there may be some language that needs to be added to the contracts just to comply with IRS regulations, but that they wouldn't be anything that would be challenging to get through or that would be objectionable to the hospital. It's really just, again, to comply with IRS regs. But he felt very strongly that he would come to the conclusion that it's a tax exempt issue.
Good.
Has bond counsel been triggered to provide an opinion?
Not yet. So they don't provide that until the bonds are actually issued. So they'll provide sort of a draft form of the opinion up front, so that goes along with the preliminary official statement. But until they've sort of worked through all of it, they don't provide that opinion until the end.
Okay. Does the fact that similar bond was issued in the past and bond counsel did provide an opinion in that case help our situation?
I believe that it does. So there's certain tests that we look at when they're determining whether bonds are taxable or tax exempt. And there's private use test, private payment test, private security test. So they go through all of these different tests to determine if something is taxable. Now, when the bonds were issued, they were larger. And sometimes with the private payment test, you're looking at revenues coming in if they exceed 10%, and this is from private payers, 10% of the debt service. That could lead to a taxable issue. There's another test that you essentially have to fail to get there. But when the bonds are larger, you've got larger debt service. So this is, it changes over time, but thank you to Jake for supplying all that stuff to TAP to look at. Dan felt very confident that it was more of, and he wasn't even certain if that language needed to be added to begin with. He was just saying, if I get to a point where I'm a little uncomfortable, we'll likely add that language or ask the hospital to do that. And he said it doesn't even need to happen prior to closing on the bonds. It's just something that we want to be able to say, we're making efforts to change these, or as the contracts are changed out, that language should be added. So as of today, I am not concerned about that.
Okay, and when it comes to, just to get us summarized a little bit, so with a positive rating of A+, we're talking 424K. With less than that rating, maybe around 375-ish.
Correct. So here's what we know today. So in the last couple of days, last week or so, we've seen the MMD, which that's municipal market data, that tracks 20-year AA rated bonds in the market. MMD has shot up between 40 and 50 basis points, which is a really, really large increase over a small period of time. Now, that's not to say that there isn't going to be a correction, and we're hopeful that we will see that correction. The reason is there's just so much volatility right now on a worldwide basis, of course, that there's less demand, and then there's this flight to safety. So we're seeing a lot of movement to treasuries, but there's also a discussion happening around the fact that treasuries and tax-exempt municipal debt are both very, very safe. But with treasuries being Fed, being sort of the older brother to munis, those are sometimes perceived as a little bit more safe. But again, there's this discussion about the value that you're receiving from tax-exempt debt is really nice compared to treasuries. So we're hoping for that correction, but the market has been like this the past several
So we're hoping
weeks.
the promise of yield will keep them in our
Right,
side.
so we're hoping this is a spike and that we're gonna come back down. So I know where you're going with this as far as what do we set this threshold at? I would say be as flexible as you are comfortable. Because the market is going to sort of bear what it will. And if we get right up to the point of sale and it doesn't look good, then we will postpone. That said, if you go out for a rating, that rating is good for 60 days. So you've got a window. The other thing that I will say is if we're going forward with the rating, you can essentially cancel that rating right up until you have the call. But once you have the call, they typically have about a week to turn that rating around. They'll take it to committee, they bring it back. And then the rating is out there for about a week. We're circulating the official statement, trying to gain some investor interest. So then you've got this 2-week period where you've gone through the rating call, and that's a hard cost to the city. So all of your other costs, I won't speak for TAF, but all of your other costs sort of fall to the wayside if you don't actually issue bonds. Typically, bond counsel fees, even if they've drafted a lot of those documents, they tend to go away as well. I've only once seen some drafting fees sent along, but if they don't go through the full process of issuing the tax exempt opinion, we would hope that those legal fees would disappear as well. But again, that rating fee is a hard fee. So if you don't go to sale, you've gone through the rating process, you've got a rating and you're not gonna use it. But we will track this, and if the day before we're gonna hold that call, things just look crummy, we call you and say, Willie, we shouldn't do this. if it looks like it's falling outside of the parameters that you've chosen, and of course, we will stay in contact up until that happens, but.
So then that really bottom tier of non-taxable issue, that's more like 200 and something?
Well, taxable, we looked at around like 252. That, we're not gonna get there. That's,
My job to think
right.
about that. though.
I mean, for the market to jump 40 to 50 basis points, I don't know that the market could, I don't think anybody knows, but the market to go up another 50 basis points seems, and I see you nodding a lot. It seems outrageous. But again, it's this worldwide instability. So sort of unprecedented times and a lot of volatility.
Would you say in your professional opinion, we're still in the trough of this particular market? Sorry,
No.
well,
But that said, that trough is, that we discussed a couple weeks back, I mean, that bottom is just going like this.
okay.
So that's to say again that we saw this shoot up in the market and that we're hoping for some correction there. Obviously, every time we're hearing on the news about, you know, Fed rates coming down, all of these things that they're trying to correct. So, and it's never a one-to-one correction. So even if they drop the Fed rate by 25 or 50 basis points, you're not gonna see that in the tax exempt market. It's not gonna be this, the same drop. But to see all of these other sort of metrics that they're trying to control, it seems odd that the tax exempt market would continue to decline. But again, it's supply and demand, and some people are looking to put money in very, very safe vehicles, and then some are just not investing at all because the yield is so low, which is why it makes doing refundings attractive, because rates are low, but for investors, it doesn't look so good. So, it's the yin and the yang.
Any questions?
So a minimum net savings of like 3.25 or something is very realistic. It shouldn't go that far down. That would be a comfortable cushion for us?
I believe so. I can't give you a recommendation, but I can tell you that I would be so surprised if we
Yeah.
got there. And that's, again, we will be in contact with Willie throughout the process, so if we get right before that rating call, if things are just, if we're inching down towards 350, I think that I'd be like, we've got to talk about this some more.
In terms of value to the hospital, Jake and Lori, what would you say the savings in terms of value would be, the minimum value that you guys would think is viable for this, for it to work for you?
Well, we're really not doing a lot of work to get a big savings, so I mean, the investment from our side, besides the minimal, I'm sure time to explain, you know, our city debt and stuff like that. I mean, the costs are what, $65,000, I think it was,
Yeah.
close to the issuance costs and everything, the discount. To get, I mean, even have that threshold of 325,000, that's significant. Over the course, I mean, of 20 years, I mean, it's significant, but in 1 year, it's 11,000, I mean, that's still significant. That's a piece of equipment, or, you know, for us, so, yeah, the savings is definitely good.
Thank you.
One other question, I believe you said earlier, the savings that we'll be getting from doing this will be a good thing for our credit, and is there any adverse effects of, say, issuing this new stuff now and say in 2 years or 5 years, the city having to go back for more debt for a project, or the city and hospital go back for more debt for a project from doing this right now?
No, I think, I do think that would be seen as a credit positive, because they do have a section within the rating report where they talk about overall management, and of course, managing your finances and looking for these opportunities, I think, is a positive. In terms of if you were to have some project needs or equipment needs, et cetera, in the next couple of years, I think as long as things are trending in the right way, and that the hospital is, of course, striving to make a profit whenever you can, I think that's all good. this debt, the USDA debt exists currently. This would just replace it. So, I think it's more of a financial performance, what they would be looking at, rather than, this being any sort of detriment to, going on in the future, so.
So I think one of the things, because you said it couldn't be paid off until 2028, so one of the
Correct.
things, and I think that's kind of where you were going with that, Jake, is if we did have a project, from our experience in a previous facility, they had to pay off all their debt in order to go down that path of a larger project. So with us not being able to pay that off till 2028, is that a potential for something like that to happen? And I don't know exactly how the circumstances were, but I just know that
Yeah,
that's how it played out.
I would assume that that was more about the funding mechanism at that time for that particular project, or saying that your, whoever was providing that financing, if they were to say, your debt ratios can't exceed X or
Mhm.
something.
Mhm.
But in the case of general obligation debt, it's the net revenues that support it, or are supposed to. And then you have the general obligation behind it. So if the city is to support a project, and they're pledging their GO, their ability to tax ad valorem, there's really no limitation there. So, again, I would say, and I don't know what the details were of that project, but I would say that it was more of a symptom of the type of financing that was being sought, or if it was a certain type of pool financing or something where they had some limitations that way.
Any other questions? Thank you. Okay, Medicare payback.
Let me see if I can get this.
No, I have one. Thank you.
Oh, it isn't. I think it might, once it comes gray, it might be fine, but I think we did shut this one down. I'm gonna do it, Jason. Perfect, thank you. Okay, so I'm gonna go over hospital clinic cost-based reimbursement along with the payback. I believe everybody is aware of, I think Lily's talked to everybody here. $1,099,617 we paid Medicare for our 2018